time to finally get another study with me ASMR video recorded. So here we are, chapter 6, VAT in business. Oh, hang on. Let's move that there. In this chapter we will look at how VAT is accounted for and how it is reported to HMRC. We will see how normally VAT is reported to HMRC every 3 months. We look at various alternative schemes of reporting VAT and how VAT is treated on imports and exports. We will also look at how the VAT on bad debts is recovered. I totally thought that's what we did last. I thought that was like literally chapter 5. Okay, so that is a mistake in the book. We've already seen that some VAT schemes will help a business's cash flow. Cash is the means by which any business survives, and without it, a business has no means to pay money owed. VAT is usually accounted for every 3 months and paid for 1 month and 7 days after the accounting period. Let us suppose your accounting period is July to September. If you raise an invoice in early July on 30-day terms, your customer will pay in early August. However, you don't have to pay over the VAT charge until the 7th of November. You therefore have the use of that cash for 3 months before you need to hand it over to HMRC. Remember that VAT can be quite significant amounts when all the invoices for 3 months are added together. However, the 3-month period can work against your business as well. Suppose you raise an invoice at the end of September, still on 30-day terms. If your customer is late in paying it, could be that you have to pay over the VAT before you've received it from your customer, effectively resulting in a negative cash flow. Even if your customer did pay on time, you wouldn't have the use of the cash as you would if the invoice was raised in early July. There are 2 basic things you can do to improve cash flow when accounting for VAT. Delay the payment of output tax or speed up the reclaim of input tax. Ways to improve cash flow. Delay payment of output tax. The reclaiming of input tax. Delaying the payment of output tax. There are a number of ways a business can legitimately delay paying output tax. We saw in chapter 2 that you can issue an invoice up to 14 days after the basic tax point. This creates an actual tax point of 14 days later than the sale. Suppose in our example above that we make a sale on the 30th of September. Using the basic tax point, the VAT must be paid. HMRC by the 7th of November. If, on the other hand, we delay the invoice by 1 day, then the tax point will be in the next accounting period and we won't have to pay over the VAT to HMRC until the 7th of February the following year. So by using the tax point rule, a business can delay paying output tax for 3 months. Okay. issuing invoice by up to 14 days. Create a later actual tax point than the basic point. If your business my headset is on its way out. If your business has an annual turnover of less than $1.35 million, you can apply to join the cash accounting scheme. Is less than 1.35 million. Using the scheme, you don't have to account for the VAT until your customer actually pays it. There will never be a case of paying VAT to HMRC without you having received it from your customer. If your business has an annual turnover of less than 1.35 million, you can apply to join the annual accounting scheme. This will have an advantage on your cash flow if you have increasing sales and presumably an increase in tax burden. The annual accounting scheme is where you make 9 monthly payments. In months 4 to 12 of the accounting year, the monthly payment is based on 10% of the amount due for the previous period. Obviously, if your tax burden is going up, you will still only have to pay 10% of your previous year's total. This means that you won't have to pay any increased VAT until the balancing payment is made 2 months after the end of the accounting year. There is the added advantage that you know in advance how much VAT will be charged each month. You can also apply to pay 25% of the previous year's payment at the end of months 4, 7, 10 of the accounting year, again with a balancing payment months 2 after the end of the accounting year. So, financial period. Alrighty, okay, the disadvantage of the scheme is if your sales decrease, in this case you'll still be paying 10% of the previous year's total amount due, even though the tax burden may be less this year. So, speeding up. So speeding up repayment of input VAT. If you normally expect to receive a repayment from HMRC. For example, if you sell mostly zero-rated goods but buy standard-rated goods and services, you can apply for a monthly tax period. You will need to complete a tax return every month, but you'll receive your repayment every month also. So that would be good for farmers. You'll be asked to comment on how VAT will affect your business, particularly cash flow. You should make sure you understand the implications of each of the above points on how it will affect cash inflows and cash outflows for the business. Changes in VAT regulations. We've already seen in Chapter 1 that changes to VAT regulations can be made annually. This often comes about in the UK in the budget. Any changes in the rate of VAT usually hit the headlines, but there are generally other changes which take place. Changes in the registration and deregistration threshold for VAT usually take place each year. There are changes in thresholds for joining the special schemes from time to time. While they are not necessarily annual events, they can be significant when they do occur. For example, from the 1st of April 2007, the threshold for cash accounting scheme went up from 660,000 to 1.35 million. Other changes are the type of goods chargeable to VAT. New rules for accounting for VAT on services from overseas came into force on the 1st of January 2010. The rules explained in Chapter 4 are these rules. Changes in VAT rate. The most far-reaching of any VAT changes is a change in rate. A government will increase the rate of VAT to either discourage consumer spending so as to reduce inflation, or to increase tax revenue to increase government spending. From the 4th of January 2011, the rate of VAT went up from 17.5% to 20% for the purpose of going some way towards paying back the government debt. The result of changes in VAT rate for business is an increased workload and expense. Consumers will be well aware of any increase, and there's a general trend for increased sales just before a rise that the consumer can get the goods at a lower price. This means a busy time for retailers. Okay, make a note of that. So governments will increase VAT. Increase inflation to raise to pay off debt. Go spending. There we go. Businesses have to change price lists both in printed material and online, and previous lists have to be withdrawn. Barcodes on all goods must be changed, as well as the price stickers themselves. Computer accounting packages and tills have to be adjusted, and spreadsheets with forecasts and cash flows have to be amended. As a general rule, businesses must charge the new rate of VAT from the date set by the legislation, so a retailer must account for VAT on all takings at the rate of 20% from the 4th of January 2011. However, the customer paid after the 4th of January 2011 but took the goods away before, the rate of 17.5% may be charged. Similarly, if a business issued a VAT invoice after the 4th of January but the goods were provided before, the lower rate may be charged. If you supplied a service which commenced before the 4th of January but was not completed until after, you have two options. The normal rules. The tax point is after the January 4th. change in the VAT rate will affect businesses using the special VAT schemes. Businesses using the cash accounting scheme will need to identify sales made before the date of the change and those after. Remember, the rate applies to the time of the sale, which is not necessarily the same as the time of payment. Those businesses using the annual accounting scheme may benefit from an upward change in rate. Their instalments will not be affected and will be based on the previous year's tax at the lower rate. Should the rate fall, the opposite will be true, and business may be paying more than under the standard scheme. However, remember that a balancing payment must be made 2 months after the end of the accounting period. If the instalments have been low, this balancing payment may be larger than normal. The percentages used for the flat rate scheme. The percentages used for the flat rate scheme are changed to reflect the increase. The businesses must use the old percentage rate on the turnover up to the date of the change, and the new rate after. This may mean recording the turnover separately for each rate. Examiner, you may be asked to comment on how a change in VAT rate will affect your business. You should make sure you understand what needs to be done and who needs to be told to make the changes. Information from HMRC. As you can see, it is essential you keep up to date with any changes in VAT regulations. While some changes are common knowledge, others may not be so well publicised. The HMRC web pages are extensive and give much of the information a business may need to know. However, the pages are extensive and it may take some time to track down some technical information. The website is at blah. If you can't find what you need on the website, you can telephone for advice. HMRC have various phone numbers, but the VAT helpline is blah blah blah. Before they can answer your query, they will want your VAT number and postcode. Inquiries made by non-registered businesses. Business will need to give their postcode. HMRC can be contacted by email. Suitable addresses are given online, but you should be aware that emails are not secure and may be intercepted and read by unauthorised people. You may not want to send personal details to HMRC in an email. Even if you do, HMRC may wish to reply by post if it contains personal or confidential information. If you write to HMRC, you must make sure you provide your VAT registration number, if you're VAT registered, your full postal address including the postcode, your daytime telephone number, full details of the situation or transaction, an explanation of what you're unclear about and why you can't make a decision about it. The following information should also be given in the letter. Is the business the supplier or the customer? If your business is a VAT registered supplier, is the customer registered for VAT? Is the query about goods or services? Which country or countries are the supplier and the customer based in? If the business is selling goods, will the goods be leaving the UK? If the business is providing services, what sort are they? Timing of VAT transactions can make a difference to the cash flow of a business. There are legitimate ways of delaying payment of VAT due to HMRC and speeding up repayments. Changes in VAT regulations occur regularly and may be significant. Changes in the rate of VAT have far-reaching implications for businesses. When a change in the rate of VAT occurs, there are some special cases for what rate to apply and when. Businesses using special VAT schemes will need to take extra care when dealing with a change in VAT rate. HMRC is contactable by email, phone or letter. HMRC has an extensive website where details of what the VAT regulations are and how to apply them can be accessed. Which of the following statements are allowable under VAT legislation? You can delay payment of VAT to HMRC under the standard scheme by raising an invoice up to 14 days after the sale. Yes. Which I find it allowable. You can delay payment of VAT to HMRC under the standard scheme by not raising an invoice until the customer has paid for the goods. sales are increasing. Which of the following statements are allowable under VAT legislation? You can speed up repayments from HMRC by joining the flat rate scheme. You can speed up repayments from HMRC by applying for a monthly accounting period. Yes. You can speed up repayments from HMRC by joining the annual accounting scheme. And you can speed up repayments from HMRC by completing the return online. List 4 things a business will need to do when a change in the rate of VAT is announced. Update prices. Listed prices and price tags. Update tills. List 4 things a business will need to do when a change in the rate of VAT is announced. Update listed prices and price tags. Update tills. Update accounting software. I can't actually think of 4. I'm sure they'll tell me. If an increase in the rate of VAT is announced for the 1st of January from 20% to 22%, which rate of VAT will apply in the following circumstances? So a customer pays for goods before the 1st January, but they are not ready for delivery until after. It will be 20%. A customer is having his house redecorated. The work starts before the 1st January, but it is not completed until after. A customer buys goods before the 1st January, but the invoice is not raised until after. Using the 14-day rule, I would say it's then 22%. A customer leases a photocopying machine. Payments for the lease occur monthly. Um, 22% for down payment. When writing to HMRC about a query on a VAT matter, name 4 details you should include about the query. Country of supplier stroke customer. Goods or service. Is customer VAT registered? What your query is. Alrighty, let's look at the answers. So we've that was a bit loud, sorry. A, C, and D. B. Alright, so we've got publish new price lists. Change barcodes. Oh, that's... Change price tags and price stickers. Adjust computer software for new rate. Adjust electronic tills for new rate. Ensure old price details are withdrawn. Adjust forecast and cash budgets. Oh yeah. Alright, so it should be, we have got 20%. 20% were done before and 20%. Yep. Alright, so that should be, a customer buys goods before the 1st January, but the invoice is not raised until after using the 14-day rule, so it's 20%. The rate applicable on the date the payment is made. Yeah, so that would be choose from, is a business supplier or the customer. If your business is a registered supplier or it's a customer registered fund. There we go. Is the query about goods or services? Yep. Which country or country supplier and customer based in? If the business is selling goods, will the goods be leaving the UK? If the business is providing services for the sort, are they? Okay, so no, that's not quite good enough. Right, supplier the customer. Alrighty, that is chapter 6 done. Thankfully that was a short chapter.